Welcome, everyone. Today we're unpacking something that touches almost all of us at some point: real estate and taxes. Specifically, we're looking at the Indian Income Tax Department's official rules for income from house property. Now, I know that sounds like a dense maze of legal jargon, but we're going to break it down step by step. You'll see exactly how the government calculates your tax liability, or, your tax benefits, when it comes to real estate. Okay, let's dive into this.
Here is the roadmap for our explainer today. First, defining house property. Second, the deemed ownership rules. Third, computing your taxable income. Fourth, deductions and special exemptions. And finally, number 5, the housing loan advantage.
Before we get into the actual math, let's do a quick thought experiment. Picture a totally empty plot of land you just bought. Got it? Now, picture a finished, fully constructed apartment. Do you think the government taxes them the exact same way under these house property rules? Keep that in mind, because the answer sets the foundation for everything we're about to cover.
Let's start with Section 1, defining house property, understanding the foundation. So to even be charged under this specific tax category, the property has to be a building, or it has to be land that is appurtenant, which is basically just a fancy legal term for land directly attached to that building, like a parking lot or a courtyard. Meaning, to answer our previous question, income from a purely vacant plot of land escapes this house property category entirely. Also, this income is taxable only for the owner. And there's one huge exception here. If you use the property directly for your own business or profession, the income isn't taxed here at all. It shifts over to business income. It's all about what the property physically is and how you actually use it.
Now, what if you're just living in the house? Well, then it's classified as self-occupied. If you occupy the property, or even if you simply can't occupy it due to your job location, it falls into this bucket. But here is the absolute game changer for homeowners. The annual value for up to 2 of these self-occupied properties is considered absolutely nil. That's right, for up to 2 properties you actually live in, your starting taxable value is a big, round 0.
Moving right along to Section 2, the deemed ownership rules, the plot twist.
Now, what's really interesting about this slide is how incredibly counterintuitive the law can be. You might logically think, hey, my name isn't on the official registration deed, so I definitely don't owe the taxes on this house, right? Well, wrong. The tax rules have this concept called deemed ownership. This basically means the taxman can legally consider you the owner for tax purposes, regardless of whose name is on the official paperwork.
Let's walk through exactly how the taxman uses this to close loopholes. Say you try to avoid taxes by transferring a house to your spouse or to your minor child for free, just to dodge a higher tax bracket. The tax code essentially says, nice try, and you remain the deemed owner. The same logic applies if you hold indivisible terrace rights, or if you get a building through a co-op society. Even if you take physical possession of a property under a written contract without official registration, or if you hold a lease for 12 years or more, boom, you are instantly the owner in the eyes of the tax department.
All right, Section 3, computing your taxable income, the recipe.
I want you to think of this calculation as a simple 3-step recipe. We don't need to get bogged down in dense math. First, we determine the annual value of the property. You figure this out by looking at municipal value, fair rent, standard rent, and the actual rent you received. Second, you get to subtract the municipal taxes, but, and this is a big but, only if you, the owner, actually paid them during that specific year. Finally, step 3, you apply your standard and interest deductions. Whatever's left over, that is your final taxable income for the property. Very logical, very structured.
But as you'll see, your starting ingredient changes entirely depending on which bucket your house falls into. If it's a let-out property, meaning you rent it out to tenants, your starting annual value is based on the higher of the expected rent or the actual rent you received. But as we mentioned earlier, if it's a self-occupied property, that annual value is strictly nil. This radically changes the starting point of your tax math right out of the gate.
So the crucial point is this massive number right here, 30%. Once you take your annual value and subtract those municipal taxes, you arrive at your net annual value. From that net figure, the government just hands you a standard deduction of 30%. You literally get to slice off almost a third of that value right off the top before applying any further taxes. It's an absolutely massive built-in benefit for property owners.
Moving to Section 4, deductions and special exemptions, shrinking the bill.
So apart from that 30% cut, there are some really fascinating, highly specific exemptions hidden in the tax code. For instance, income derived from farm buildings is actually considered agricultural income, meaning it's completely exempt from tax.
Trust property used for charitable or religious purposes? Also completely exempt. Registered trade unions get a free pass under this head too. And in a very fun historical quirk, Section 1019A grants an exemption for exactly one palace of a former ruler. So, unless you happen to have a spare palace lying around, you'll probably be focusing a bit more on those standard deductions.
But what happens if your property calculations actually result in a loss? Say your deductions far exceed your property income. Well, this can actually be a huge strategic advantage. The law allows you to set off up to 200,000 rupees of house property loss against other heads of income in the same year, like your salary, for example. And if you still have unabsorbed losses after that, you can literally carry them forward for up to 8 years. Just remember, pay close attention to this. If you have opted for the new default tax regime under Section 115BAC, this total set-off against other income heads is not allowed.
And that brings us to Section 5, the Housing Loan Advantage, Leverage and Limits. Let's move to and see how this builds on our previous calculations. Under Section 24B, you get to deduct the interest you pay on borrowed capital, like your mortgage. Now, if your property is let out, you get a full deduction for the interest paid or payable. There is literally no limit. Even if the interest exceeds the property's annual value, you can claim the whole shebang. But for self-occupied properties, because your annual value already starts at nil, the government strictly caps exactly how much interest you can deduct.
And that cap for self-occupied properties is usually 200,000 rupees. To qualify for this maximum deduction, there are a few rules. The loan must have been taken on or after April 1, 1999. It has to be specifically for the purchase or construction of the property, and the property must be completed within 5 years of borrowing. If you just took out a loan for repairs or renovations, that limit drastically drops down to just 30,000 rupees.
This perfectly illustrates just how detailed the tax code gets. Like you might be wondering, what about the interest you paid before the house was even finished? Good news, that pre-construction interest is totally deductible in 5 annual installments, starting the year construction completes. Another huge benefit is that this deduction is on an accrual basis, meaning you can claim it even if you haven't actually paid the bank yet, as long as the interest accrued. Refinancing? That's eligible for sure. Just don't try to deduct your broker's commission or the bank's processing fees. Those are strictly off limits.
Now, I really need to highlight a crucial modern caveat here that could upend your entire tax strategy. The government recently introduced a new default tax regime under Section 115BAC. If you choose to file your taxes under this new default regime, that fantastic interest deduction for a self-occupied house property is completely wiped out. It is strictly not allowed. You absolutely have to run the numbers carefully to see which tax regime actually saves you more money overall.
Which leaves us with this final thought. We've seen the nil valuations, those huge 30% standard deductions, the strategic carrying forward of losses, and some very significant loan interest write-offs. But on the flip side, we've also seen deemed ownership traps and the very strict rules of the new tax regimes. So do the tax benefits and deductions of real estate investment ultimately outweigh the complexities of computing it all? I highly encourage you to go review your own property portfolio right now with these rules in mind. Thank you so much for joining me for this explainer, and keep learning.